G'day and welcome to this week's video. My name is Robert Goudie from Consortium Private Wealth. This week I thought I'd have a quick conversation around a question I had from a client, which is a very good question. This guy is quite interested in watching the market and reading some of the reports that come out from businesses. And his question was, why do businesses go down when the report they just released seems to be quite positive? And what I mean by a positive report, and that can be where profit has gone up and revenue has gone up substantially, and there are some highly scalable tech businesses that go up very fast, but sometimes they might report 20% increase in revenue and profitability, but yet the share price gets smashed that very day. Obviously there can be a combination of things of why that happens. One is that they really haven't met the expectations of what the market were going to expect. So if the profit was up by 30%, but the market was expecting 38, well, they're going to be punished because the markets had expectations. And like all markets, particularly the share markets that trade every day, they are forward thinking. They're always thinking 9 to 12 months out. They can have increased expenses or decreased margin. Sometimes increased expenses can be a positive thing. That can be the business reinvesting back into the business. There's also, I think, a huge amount of short-term thinking within the market, and whilst we like to think that we're all long-term holders of businesses, many of the information that's peddled out to us from analysts or just the ebbs and flows of the market cause us to concentrate on what's happening in the short term and get spooked and potentially sell at the wrong time. And that sales in the short term can really push the share price down just from a supply and demand point of view. For me, a lot of these things are very much focused on the short term. And when I buy businesses for myself and for my clients, I encourage people to look very much long term. And I'm not just saying long term through to retirement. I'm talking about long term through to life expectancy. So I'm more worried about where the business is going to be in 5, 10, 20 and the rest of your life time frame. And that means that we don't need to focus on the ebbs and flows in the short term, or business means that their expenses are high and profit will be down because of that, because they're reinvesting. So they're foregoing today's profit to invest into tomorrow's future. So if we're patient investors and are truly holding for the long term, what happens in the short term is really of no concern to us. As long as we know that the businesses that we invest into are continuing to improve their products and services with an eye of providing value for their clients. So if that's their focus over the long term, this will drive revenue and profitability, and that is the key driver to the value of any asset. What is the profit that it brings in now, and what will it be in the future? And if they continue to reinvest heavily over the long term, I would not be overly concerned what happens in the short term. So just my take on what I thought was a very good question, and it's worth going and having a look at some of the reinvestment and doing a Google search on how much research and development do some businesses do. And if you look at Amazon and Google, I think they're just over $25 billion is what they invested within a 12-month time frame. So that reinvestment is, that will pay off as they improve their products and services. Thank you for listening, and we'll catch you next week. See ya.